Ladies and gentlemen, good afternoon. Please welcome your host, Tina Wallace.
Hello and welcome to Life After Tax Reform, What You Need to Know, here at the 2018 BECU Member Summit. I'm Tina Wallace, VP of Accounting at BECU, and on behalf of all of the staff here, just want you to know that we're thrilled that you're joining us this evening. We are live streaming portions of the annual meeting tonight through Facebook Live and on our website, so I'd also like to extend a welcome to those of you who are joining us online. Our speakers this evening are Jay Forkin and Melissa Thomas with Deloitte. And Jay is a tax partner in Deloitte's Seattle office, where he serves as the leader of the Deloitte private tax practice for the firm's Pacific Northwest offices. He brings over 17 years of experience serving primarily privately held companies, family-owned businesses, family offices, and individual owners. Melissa is a senior manager in Deloitte's private wealth practice, where her focus is serving private companies and their owners, as well as high net worth individuals and family offices. Melissa brings extensive experience in dealing with complex tax issues facing privately held entities and their owners. She has experience in areas of S corporation and partnership tax issues and compliance, international income tax issues, and individual income, estate, and gift tax planning and compliance. Please join me in welcoming Jay and Melissa to the stage. We're very excited to have them share their experience on what we need to know as a result of the recent tax reform.
Great. Tina, thank you very much for the great introduction, and thank you for inviting us to be a part of this year's Member Summit. We are excited to be here. And thank you to all of you, and welcome. It's not lost on me that we are competing with a 70-degree Seattle spring day. And so weighing the option of having to come to listen to somebody talk about tax reform or go play in the sun, we appreciate that you made the choice to come spend a little time with us. So thank you. So I'm sure all of you didn't get up in the morning, get out of bed this morning and do a big fist pump and say that the day that I finally get to go to the BECU Member Summit and hear about tax reform has finally arrived. We realize that that the enthusiasm around taxes and tax reform probably resides here on the stage. So what we really wanted to do was kind of one, give you a high-level overview of what's been going on. Tax reform has been in the news. There's been articles all over the place, and so it's been an ever-evolving process for about the last year. And what we want to do is kind of take a step back and give you some high-level overview of some of the things that happened, and focus specifically on some of the international pieces of tax reform that affect all of us in this room here. So let's take a look at our agenda here. So I'll spend just a few minutes giving an overview of tax reform, primarily on the process that it took to get tax reform actually into law. I'll keep it high level, but I think it's interesting to understand how our government, and namely Congress, kind of worked this from the ground up and ultimately got to the point where it became law for all of us. I'll spend literally just a couple minutes on the business and international provisions, again, high level, but this was such a significant part of tax reform that I'd be remiss if I didn't at least mention a little bit about it. We want to spend the most of our time here today with you talking about the individual specific provisions that impact all of us, and provide you with maybe a couple things that you can leave here today with you to maybe implement into your own financial tax or financial planning strategies, and while you're at it, minimize the amount of tax you have to pay in the process. And so hopefully at the end we'll have a few minutes for some Q&A, but let's jump into it and get started. I wanted to start off with a quick quote from the late actor Will Rogers. He said, "The difference between death and taxes is that death doesn't get worse every time Congress meets." And I found this to be particularly funny, considering that Will Rogers passed away, I think, in the 1930s. And he was he had great foresight to realize that, in the past 6 to 12 months, this is absolutely what's going on. Congress has made this extremely complex and very complicated, and I just thought it was a very, very timely and appropriate quote. So let's see here. So, in the interest of time, I think I'll skip this one. This just shows the activity that Congress has had in the last 30 years with respect to tax reform. Here's where I do want to spend a couple of minutes, though, talking about the process that it took to get tax reform here with us today. So if I were to come to you and say, here's a list of 10 issues, you can be on either side of the issue. And give you first crack, and say, okay, each of these 10 issues, you get to pick which side you want to be on, and I'll pick the other. But I also get have the right to pick the process through which law is going to be crafted and enacted with respect to these 10 things. I'll guarantee you that I'm going to win 10 out of 10. And so the point of that being that the process that Congress used to push this through and ultimately make it law far outweighs the significance of any content that was involved, and I'm going to talk briefly about that here in a moment. And so typically when you have a bill that moves through the Senate, you need a 60% majority vote to get it through onto the president's desk so that he can sign it into law. There's a process called budget reconciliation, which basically reduces that 60% requirement to a simple 51% majority requirement. Now, the reason that's important is because at the time the tax law was voted on, the Republicans held a slim 52 to 48 advantage over the Democrats in terms of seats within the Senate. The vote on tax reform was right down party lines, meaning that not a single Democrat voted for it and not a single Republican voted against it. And so without this reconciliation process, it would have been impossible to get the current bill through Congress. The other thing, using this process, so the Republicans in Congress had to work within basically a self-imposed restriction of anything they did in terms of tax reform could not add more than $1.5 trillion to the national deficit when you look at it over a 10-year period. And so what's interesting about that is if you take a look at where we're at today, so 2018, and you look at the tax breaks that were given to corporations, small businesses, individuals, and you project that out for 10 years, that far exceeds $1.5 trillion in lost revenue for the government in the way of tax reductions. So how did Congress make it work? Well, what they did is they took a step back and they said, all right, we're going to break this apart. Corporations, we're going to make all these tax breaks for you permanent. Small businesses and individuals, we're going to make these tax breaks temporary. So let's just say for the first 7 years, you guys get these nice tax breaks, but beginning in year 8, those tax breaks expire. And in year 8, you go back to what the law was before tax reform, which generates additional revenue for years 8, 9, and 10. And when you do the math on that, that's how they were able to fit this within the budget reconciliation process. And so you can see some push and pull from a political standpoint, being that the tax rates for corporate America are permanent. The tax rates for small businesses and individuals are temporary and currently are set to expire after the year 2025. So that's one thing to make note of. I'll skip that slide. And so briefly touching on the business and international provisions here. So the single most impactful tax break in this whole thing was the reduction of the top corporate tax rate from 35% down to 21%. So a 14% reduction in the top tax rate that applies to corporations. 29.6% on pass-through income. I'll talk more about that on the next slide. Maybe the final thing I want to mention on this slide is the 100% capital expensing. qualified property. Basically what this is an incentive for companies to reinvest in themselves. So spend money to increase the capital in their business, go out and buy assets. And so how that was treated previously for tax purposes is companies got to write off about half of the cost of new machinery, new equipment in the year that they bought the equipment. And then the rest of it, they had to depreciate over time, and eventually they would get to recover the cost and write off the full cost of the equipment. It would just take them a while to do it. Now under the new law, they get to write off 100% of it in the year they buy it and put it to use in their business. So the pass-through deduction, so when we talk about the pass-through deduction, we're talking about the type of legal entity that the business is formed as, is created. And so these are things like LLCs, partnerships, S corporations, even sole proprietorships. And so, excuse me, I mentioned earlier that the top corporate rate dropped from 35% down to 21%. These pass-through businesses, the way that the income from these businesses are taxed, they're taxed to the individual owners at whatever rate applies to them. And so Melissa will talk about here in a moment, the top individual rate dropped from about 40% down to 37%. And you're saying, well, wait, so if I have a small business that's structured as a pass-through entity, I'm going to be paying tax at 37% versus all these large multinational corporations that are going to be paying 21%? And the answer is, yeah, maybe. So the one thing that Congress did to kind of counteract that was to build in this special 20% pass-through deduction, which ultimately, if you meet all of these tests and these hoops that you have to jump through, you can effectively take a deduction for 20% of the profits that are generated by your pass-through business, which ultimately results in you paying tax on about 80% of your business profits. If you do the math on this, the effective top tax rate on pass-through entities is about 29.6%, so say 30%. So you're still looking at a 9% difference on income generated by small businesses and income generated by large multinationals. And so there's still a large gap. I'm not going to get into all the hoops and the hurdles you have to clear to qualify for this. Just know that it's not a slam dunk. If you're a small business owner, you're not necessarily going to get the 20% deduction. You still have to make sure you clear all the hurdles and requirements. The other thing I want to mention is that this 20% deduction does not apply to specified personal service businesses. So if you think of things like attorneys, accountants, doctors, other professionals in the healthcare profession, if you own your own business and you're generating income from what they refer to as personal services, then you don't qualify for this 20% break. Okay. With a caveat, if your income from those businesses is below certain thresholds, and so if you're a single taxpayer, it's less than $157,000. If you're a married couple filing joint, then if your business income is below $315,000, then none of those restrictions that I just mentioned apply. And so, was this an exercise in tax simplification? Absolutely not. The point being, once your business income reaches a certain level, then you start becoming subject to more and more restrictions, and point being, you may not get this nice 20% benefit that Congress was advertising when they rolled this out. So the last point here, the deduction only available through 2025. So in 2026, we're back to individuals pay tax on small business income at 40%, corporate America 21%. The international piece, again, very, very high level. The old rule with respect to domestic companies that had businesses offshore was that as long as you were generating profits and earning income in foreign countries, the U.S. said, we're not going to tax that until you bring those profits back into the U.S., until you bring that cash back. Tax reform changed that. And they said, if you're continuing to generate profits offshore, generating revenue, making a profit, we're going to start taxing a portion of that, whether you bring the cash back or not. So it's been a shift from a deferral system, from a worldwide deferral, to we're going to look at everything worldwide, and the U.S. is going to tax a portion of it currently. So with that, I think Melissa's going to get into some of the provisions that all of you came here to hear about. So.
Bear with me, I'm not very good with technology. All right, a little bit of tax humor for us. So hopefully at the end of this, after you've heard what we say about the individual tax provisions, you'll decide if you think that this is a tax loophole, so it's benefiting somebody else, or if you think it's tax reform benefiting you. So we'll jump in really quickly. So Jay alluded to this one a little bit earlier. So the drop in the individual tax rate. So the top rate used to be 39.6%, and now we've seen that drop down to 37%. And so what we've also seen in conjunction to that is they've expanded the tax brackets. So in the US, you get to look at your income and you build up on it. So you look at the first 10,000 and it's subject to a rate of X. The next 10,000 is Y. And so you build up to that. And so what also happened during tax reform is these brackets were expanded. So it takes longer for you to get to the top tax rate. Hopefully you guys have seen some of this. If you're earning a salary right now, you would have seen the impact of these changes in the tax brackets and the tax rates come into play in February when the IRS released the new withholding schedules. The next piece here has gotten a lot of, I'm not sure if you can see, yep, perfect. The next piece that's gotten a lot of play in the news is the change to the standard deduction. So what we heard throughout tax reform was the goal was to make it simpler. We'll leave it up to you to decide if you think it's actually simpler or not. But with doing that, they changed a lot of the rules around itemized deductions, which we'll get into that a little bit earlier, or a little bit later, excuse me. But part of that, with changing the itemized deductions and limiting that, is they said, well, we need to do something. And so what they've done is look at your standard deduction. And so from a tax perspective, historically, you've been able to take either the higher of your itemized deductions or the higher of your standard deduction. And so what we've seen is they've actually doubled that. So we've gone from about $6,300 for a single person, or $12,700 for a couple filing married, filing joint, all the way up to $12,000 for a single person, or $24,000 for a couple filing married, filing joint. Oh, sorry, thank you. I appreciate that. I'm from Atlanta, so I talk extremely fast and extremely Southern, so I appreciate it. So from a personal exemption perspective, so historically the IRS has let you take a deduction on your tax return for personal exemptions. And so for every individual on the return that you're claiming as a dependent or as a member of your household, you could take a deduction for $4,000. So what they've done under tax reform, though, is they've actually decreased that all the way down to zero. So starting in tax year 2018, you can no longer claim a personal exemption. Going back to what Jay talked about earlier with needing to pay for the tax bill, this is one of the things that came out. This is one of the revenue raisers I believe they gave up. The second part, or sorry, the fourth part on here is AMT. So I'm not sure how many of you are familiar with AMT. It's something that when I started my career in tax always baffled me. I was like, why do I have to calculate things under regular tax? Why do I have to calculate it under AMT? And so the IRS back in the Congress back in the 1960s actually decided that wealthy individuals were getting too much of a benefit from all these deductions available to them. And so they said, what we're going to do is we're not going to change the deduction rules. We're going to actually create a whole nother parallel tax system. And so what you're going to have to do is calculate your tax under the AMT rules, and then you're going to have to calculate it under the regular tax rules. At the end of the day, you're going to pay tax at the highest of those. So the highest of your regular tax or the highest of AMT. So what they've done here is actually increase the exemption. So there's a certain amount of income you get to back out when figuring out if you're subject to AMT. They've increased that, so that's potentially a good thing. And they've also increased the phase-out threshold, so the people who are allowed to take this exemption. What we'll talk about in a second with itemized deductions, kind of almost, I think, and I don't know what your thoughts are, Jay, makes the AMT piece kind of not a big deal. Yeah,
I would just say, so the key takeaway from this slide, I would say, if we could put the slide back up there for a moment, please. So is the changes in the standard deduction and the personal exemptions. Yeah. And so I just read an article the other day that they expect the number of tax returns that are filed by individuals who itemize their deductions to go down by 61%, meaning that the itemized deductions that they've stripped away and the coupled with the increase in the standard deduction is going to basically, like I said, reduce the number of tax returns that the IRS is going to receive, where it's more beneficial for an individual to itemize their deductions because the standard deduction is going to be higher. The other thing here that's I think important to note is the repeal of the personal exemption. If you're a family of 5 or a family of 6, and you've historically been able to claim a $4,000 deduction for every single person in your household, thank you for doubling my standard deduction, but you just took away $25,000, $30,000 of deductions that I was getting before that, and so this benefit may be completely offset by some of the things that were that were taken away by Congress. And so you really have to look at what provisions apply to you and how you're gonna be after applying these to figure out whether this is going to be a good thing or a bad thing for you. So
yeah,
sorry.
No, absolutely. And so this first part up here, this limitation on itemized deductions. So Congress, again, I think it was in the 1990s, decided that, again, they felt wealthy people were getting too much of a benefit from their itemized deductions. So itemized deductions are things like your real estate taxes, your state income tax payments, tax preparer fees, attorney fees if they're associated with determining your tax liability, charitable contributions, and some other items. So,
sales tax.
Sales tax, too. That's a big one for Washington. And so what Congress said was, okay, we're going to put in this thing called the PEAS limitation, and it's actually named after the congressman who pushed this through. Sorry. So for the PEAS limitation, they would say, okay, you look at your itemized deductions, and then take 3% of your adjusted gross income, and say you've got to cross another hurdle in order for you to be able to claim these deductions. So you have to back off this 3% piece, and then that's the amount you actually get to take. And so it sounds like a good thing when I say that they've repealed that through 2025, but what we're about to talk about is they actually just took away a lot of the itemized deductions that would have been subject to the PEAS limitation in the first place. And so one of the big ones we've seen is the state and local tax deduction. So previously, you could deduct all of your real estate taxes and all of your state income taxes that you paid. What they've done now, and this is one of the big ones that's been in the news, so you may have seen it, they've limited that to $10,000, and that's combined. So it's not $10,000 for real estate and then another $10,000 for income tax. It's actually $10,000 between your real estate taxes and your state income taxes. So while at first blush you look at this and think, oh, I'm in Washington State, maybe it's not a big deal. We don't have an income tax. To what Jay talked about earlier too, the sales tax is also included in this. So unfortunately, this deduction's gone down to $10,000 as a max. The second piece is the mortgage interest deduction. And so previously on up to $500,000 or $1 million of mortgage, which in today's real estate market isn't really a ton of money sometimes, you could deduct the interest expense that you incur on that. So whatever you pay the bank for your mortgage on the first $500,000 or $1 million of borrowings related to your primary house or secondary residence, you could actually deduct. What they've done now is they've actually changed that to say, well, we're no longer going to say it's $500,000 and it's not going to be $1 million. It's going to be $375,000 or $750,000, depending on if you're filing single or married filing joint. The thing to note here that I don't think got a lot of publicity is if you had a mortgage in place, I think it was as of December 16th, you are able to actually, you're grandfathered in. So you can continue to follow the same $500,000 or $1 million threshold that was in place then. Any new debt, though, is going to fall into this $375,000 or $750,000. So again, sounds like we talked about earlier, AMT, oh great, they took that, they've made some changes to that to make it where less people are going to be subject to it. But end of the day, we don't really have the big deductions that people used to have. So going back to what Jay said earlier, great, you increased my standard, but I mean, is it really that much of a benefit depending on what you used to claim? The other one that I'll mention is the Affordable Care Act. So I feel like in the media we've seen a little bit of play like, oh, the Affordable Care Act was repealed. It wasn't actually repealed. What they've done is kind of take away the penalty. So previously, if you didn't have insurance coverage for the full year, you could potentially incur a penalty and have to pay that as a part of your tax return. They've taken that away now, so there's no penalty, but the Affordable Care Act is still in place. The other one, though, that actually is a great benefit, I think, is the child tax credit. So it used to be you only could take $1,000 of a credit, and so credits directly offset your taxes dollar for dollar. So instead of a deduction which just offsets your taxable income, a credit will actually offset your tax liability dollar for dollar. And so under old law, you could take $1,000 per child under the age of 17 if your AGI was under $75,000 or $110,000. And that might not be a lot of money when you're looking at your household income. What they've done now, though, is actually say it's $2,000 per child. So they've doubled it. And they've also increased the thresholds for your income. And so that's now up to $200,000 or $400,000 if you're filed married and filing joint. So hopefully offsetting some of the pain from losing that personal exemption that we talked about earlier. The other great part of this is $500 per non-child dependent. So if you have elderly parents, or maybe you have a family member that you're helping take care of and provide for, you can now claim this child tax credit as well. The other piece that I might just skip over is the carried interest. They've just changed the holding period requirements on that, but won't spend too much time on it. And the last piece that we'll talk a little bit more about later is the estate and gift tax exemption. And so the big thing here is the exclusion amount that they had is actually doubled. And with that, we'll move along. The big one on here is the charitable contribution limitation. So this is one where they actually increased the threshold. So previously, you could take 50% of your AGI as a charitable contribution deduction if you gave away that much. They've actually increased that limit now to 60%. And this is one of the few individual income tax items that's not set to sunset. So this one's actually permanent. The other one is the permanent repeal of the deduction for alimony payments. So for alimony agreements that are entered into after December 31st, 2018, if you're paying alimony to an ex-spouse, then previously you could have deducted that on your tax return, but now that's no longer deductible, and there's no sunset to that either. I'll turn it over to Jay.
Okay, great. Thanks. So if you're sitting there thinking, holy smokes, that's a lot, and that's a lot of numbers, and it's really confusing, and I missed half of that, don't worry. You're in good company. The key thing to, again, take away is there was a lot of give and take. And so depending on your specific situation, your family's specific situation, really whether you're better off or worse off under the new tax law, it completely depends on your specific set of circumstances. So one of the things we'll kind of transition here into is kind of some of the planning opportunities that exist. So some of them are old and they've been around for a while, but they still make good sense to think about in today's day and age. And so the first thing is get the slide up there. So halfway down, so loss harvesting. Well, what the heck is loss harvesting? So if you've got transactions that happen throughout the year, say you sell stock and you have a realized gain, or you sell a rental property and you've got gain to pay tax on. So as you move throughout the year, if you kind of keep track of what's going on with respect to these gains that you're ultimately going to have to pay tax on, you get to the end of the year and you're looking for ways to offset some of these gains. One thing you can do is what we refer to as loss harvesting. You can look at your portfolio, see if you have any stocks that have declined in value. Does it make sense to sell those from an overall investment strategy standpoint? And if it does, you can sell those stocks, generate a loss, and that loss can offset some of the capital gains that you've incurred throughout the year, ultimately reducing the tax that you're going to have to pay. So the thing I just want to stress here is don't let the tax implications drive your investment strategy. And so selling a stock that you think is just in a little bit of a lull but is going to rebound just to reap the tax benefits of it probably isn't a great long-term investment strategy. And so just make sure that if you are loss harvesting, you're taking everything into consideration, including your investment strategy, investment policy, when you're looking at trying to get some of these tax interplays here. Short-term versus long-term holding periods. So I think most of you are aware if you hold a stock or capital gain property for more than a year, you get a preferential long-term capital gains rate on it, which is about half of what the top ordinary rate is. And so if you sell an appreciated investment before that year mark, then you have to pay generally a higher tax rate on that. And so if you're approaching that 1 year mark, and you can, again, from an investment strategy standpoint, wait until you cross that 1 year threshold, there might be some tax savings for you in waiting that extra time to get the preferential tax rate on it. Increased charitable contribution limitations, Melissa talked about that. You might say, well, who the heck gives away half of their income away every year to charity? That's a great question. I only know a few, but it does happen. And so one of the things they did was they increased the 50% of AGI limit that you can give to charity. They increased that to 60%. So, and again, the timing of charitable contributions. If you have a relatively, low income year and your taxes are going to be low because you're in a low rate, and you're considering making a large contribution to your alma mater or United Way or whatever charity that you have a passion for supporting, if you know that for some reason you're going to be in a higher tax bracket the following year, think about waiting to make that in a year where your tax rate's going to be higher, so you get more bang for your buck for your charitable donation. So just timing the deduction with the significant income that you're going to have if you find yourself in that spot. Charitable contributions of appreciated securities. Again here, if you have a donation that you're looking to make, wanting to make, and you have stock in your portfolio that's appreciated, consider making that donation with your appreciated stock. One, you get a tax write-off for the full fair market value of the stock or securities that you donate, and that unrealized appreciation goes to the charity completely tax-free. You don't have to pay tax on that. So you get a full benefit for your donation without having to pay the tax on the appreciation that you've realized as you've held it. And so it's a good strategy for making your donation, but avoiding the capital gains that would result if you were to sell that same stock and then give the cash.
And so we'll spend a few minutes talking about education planning. And so this is a great planning opportunity for you if you have a family member or somebody that you care about and want to help kind of cover their education costs. And so the government's actually got a couple of options that you can actually take some money and set it aside to pay for somebody's future education costs, and that money will grow tax-free. And then when the money comes out, it actually won't be taxable as long as it's covering qualified education expenses. And we'll talk in a second about what that is. And so two of the bigger options, and these are by no means the only options, but two of the more popular options are a 529 plan or a covered ESA. And so it used to be that 529 plans, you couldn't take the money and use that and apply that towards like primary or like early childhood education costs. So you couldn't use it to pay for a private elementary school or private middle school or high school. But they've actually changed that law. So as of, I think, 2018, you can actually use the cash from a 529 plan to cover those types of costs. So a lot of what we're seeing is there's not as much of a distinction between the 529 and covered ESA, except for a couple of things we'll get into. So the 529 plan, the maximum contribution here, it's determined on a state-by-state basis, and it depends on which state you decide to put your 529 plan with. It's established by that state, and so some of them have limits in excess of $300,000. So pretty big in comparison to the covered L that's only going to let you put away $2,000 annually per beneficiary. And so for the federal tax income implications between the two plans, they're actually the same. So it's not a deduction for you when you contribute, but it's not taxable when it comes out. Again, as long as it's used for qualified education expenses. The thing here that I think people sometimes forget about is the government wants you to save for education, but they also have rules around gift tax. And so you need to watch the money that you're contributing to these plans to make sure you're not tripping up any sort of taxable gifts. And so that would be a contribution that for 2018 is in excess of $15,000. One thing I'll mention, though, on the 529 plans that's actually pretty powerful is you can, what I'd say is front load these. So there's a special exclusion here, and if you make the election, you can actually contribute $75,000 worth, so 5 years worth of contributions to your 529, so that's $75,000, and not pay a gift tax on it, even though it's in excess of $15,000. So that allows you to get the money into the plan earlier, and it can hopefully grow faster and start accruing more income. Let's see. The other piece on here that I'll just mention is the income and age restrictions. So there's no income or age restrictions on contributing to a 529 plan. So when I say income restrictions, I mean on you as setting up the plan. So it doesn't matter what your income threshold is. You could set up a 529 plan for someone. If you have a covered ESA, you can only make $110,000 as a single person, or $220, excuse me, as married filing joint. So something to consider there if you're choosing between the two plan types. The other piece is that on a 529 plan, you can fund these. There's no age restriction on the beneficiary. So if you had someone in your family that all of a sudden at age 29 decided that they wanted to go back to school for something, you could start setting up a 529 plan for them. But if you're looking at a covered plan, you can only make contributions to it up until the beneficiary turns 18. Just something to think about. Some of the other considerations are for the 529 plan, it's important to look at the state that has the rules around the plan. So if you're looking at like the state of Washington or the state of Georgia's plan, understand, can I use these education expenses? What if I have somebody who wants to go out of state for my secondary education, if they want to go out of state for college? And then also, what are the fees charged by these plans? The second piece on covered L, just know that here the money has to be used by age 30 for that beneficiary, versus again 529, you don't have that issue. And that if you have money in a covered L that hasn't been used yet, you need to go ahead and assign that to a beneficiary that's not age 30 if it hasn't been used up. I think that's it.
Okay, great. And again, so on that, I'll say the key takeaway there is with the tax law changes to the 529 plans, they've, in my view, completely made the educational IRA obsolete. The 529 plans are so much more flexible, and you can do a lot more with them. And now that you can use them to pay for private school tuition, K through 12, I think in my view, it's kind of a no-brainer that if you're looking to save for your children's or grandchildren's tuition, 529 plan I think is a great way to go. On the retirement side, a couple things, and I'll get through this rather quickly, but this is also a great income tax savings vehicle as well. And so, if you've got, if your employer offers a 401k plan, if it's a traditional 401k, which most are, you've got the ability to take pre-tax income and basically pay yourself and set it aside for retirement. So because it's pre-tax, you're not taxed on the value of whatever you put in there, and so it's able to grow tax deferred until ultimately you reach the age of retirement and you start pulling those funds out, which then they become taxable. If your employer offers a Roth option for the 401k, then just be aware that the money that you do put into the Roth 401k, you do pay tax on those funds now. They go into the Roth 401k and they grow tax-free, not tax-deferred, tax-free. And so that when ultimately you withdraw those contributions and any earnings that those contributions have garnered over time, you don't pay tax on those when you pull them out of the Roth. And so a very powerful way to save for retirement. Along the same lines, you have IRAs. You have traditional IRAs and Roth IRAs that function very similar to the 401ks that I just mentioned. The thing I'll mention here, you can set these up in addition to the 401k plans that you have through your employer, and so there's no restriction on doing one of these if you have a 401k through your employer. I will say the Roth IRA, there are restrictions as to who can contribute to a Roth IRA. So you see on the slide there, if you're a married couple filing joint, if you make over $199,000, so if you're $200,000 or more of household income, then you are prohibited from contributing funds into a Roth IRA, and so that leaves you with the traditional IRA. Typically, when you put money into a traditional IRA, you get to deduct those funds that go in, and so they end up being pre-tax because you get a deduction for them on your tax return, which is a nice benefit. However, if your income exceeds certain thresholds, then those contributions to a traditional IRA, they may not be fully deductible, and so then what ends up happening is you have what's called basis in your traditional IRA, which means that when you ultimately start pulling money out of that, not all of it is going to be taxable because you funded a portion of it with after-tax money. So the last point I'll make here, so as I mentioned, if you have income over $199,000, you're not able to contribute funds into a Roth IRA. However, you can still find a way to get funds into a Roth IRA by making contributions to a traditional IRA and then converting those funds into a Roth IRA. You can do that at any income level, and if you're a high earner, and all of the contributions that you make into your traditional IRA are not deductible, so you have basis in your IRA equal to what you put into it. You can essentially make a contribution to a traditional IRA and then immediately convert it before it has a chance to appreciate into a Roth IRA, and that conversion is going to be completely tax-free because you have basis in the funds that were converted over. So it's called a backdoor Roth, and so it's just a way for high-income earners to get money into a Roth IRA, which ultimately will be tax-free whenever it's taken out during retirement. I know we're running a little short on time.
Yeah, I was going to say, do we want to?
I would say on the estate piece, the thing that changed on the estate front is they essentially doubled the lifetime exemption amount that individuals have. So essentially, it used to be about $5 million that an individual had to either give away during their life or upon their death through their estate. That has been doubled now. So with inflation index, it's about $11.2 million. And so a married couple can give away, during their life or at their death, tax-free, pass assets to their heirs, assets with a value of up to about $22 million. I'll say that with a caveat, and that caveat is the Washington state estate tax, which is, by the way, the highest in the country. The exclusion amount on that is a little over $2 million per individual. And so even though you can exclude up to $11 million for federal purposes, if you have an estate that's in between, say, $2 million and $10 million, you may not have to pay federal estate tax, but you got to watch out for Washington because Washington still will tax you on the value of your assets to the extent they exceed the Washington exclusion amount, which, as I mentioned, is a little over $2 million. So just something to keep in mind if you're doing estate planning. And with that, I think we're probably at the point for your Q&A. Tina, do we have any time for?
Yeah, we do. I just wanted to give Jay and Melissa thanks for coming and spending their time with us today. And we do have a couple minutes to maybe take one or two questions from the audience if there's questions out there.
Yes.
What did you mean in the caveat up there of beware of multiple IRAs? What was that all about?
Yeah, great question. And so in my example, let's take a very simple example. And so say that I don't have any IRAs at all set up, but I want to figure out how to get money into a Roth IRA. So what I would do is I would look at say I make too much money to contribute to a Roth, so I'm going to do the backdoor IRA strategy that I mentioned. So I'll make let's just say a $5,000 contribution into a traditional IRA, and then immediately I'll convert that over into a Roth. And because there have been no earnings on that, because I do it right away, I don't have to pay tax on that conversion. Now, take those same facts and assume that I have an IRA that I set up years ago because I had a 401k plan at a former employee that I rolled over into an IRA after I left the company. And so what the tax rules make you do, and so if I do my $5,000 contribution to the traditional, I convert that over into a Roth, what they're going to do is they're going to make me take the total combined value of all of my IRAs, and so not just the $5,000 that I just set up, but all of the value of my old 401k that now sits in an IRA, and only the portion. So I'm going to have to pay tax on the conversion to the extent that the portion of my old IRA is to the total value of my IRA. So let's just say I had my old IRA was $95,000. So total I have $100,000 of IRA funds sitting out there. I convert $5,000 over into my Roth IRA. 95% of my IRAs are in pre-tax funds because of my previous rollover. So 95% of my $5,000 rollover is going to be taxable when I do that. And so no longer am I able to move $5,000 into a Roth completely tax-free. I've got this other IRA sitting out there that I have to be aware of the ordering rules and the combination rules that apply when I convert from a traditional IRA into a Roth IRA. I just have to be aware of any other IRAs that I have sitting out there that could cause that conversion to be taxable. Okay, good question.
I think we have time for one more question. Is there any out there?
Actually, yeah. I grew up in West Virginia. I came out of the inner city, and after I left, eventually, I became a computer scientist, and I had to engage a multi-decade process of learning to be middle class. Then I got married and moved to Redmond, and I had to learn to be upper middle class. Okay, so I was just thinking how pissed off all this talk would have made me when I was a poor person. There's an awful lot of people who are BECU members who make under $100,000 a year for their whole household. And I was wondering if you have any advice specifically for folks like that. Thanks.
Yeah, I would say, so the advice I would say is if you're looking for ways to reduce the amount of tax you have to pay, look at the things that we talked about, one being the retirement plan options. Retirement plan is a great way to fully utilize your employer 401k if you can to reduce your taxable income. And oh, by the way, you get to do that while you're paying yourself for later in life. And so I would say that's the simplest and the easiest when I do taxes for my parents and taxes for my friends, and they say, why do I have to pay so much tax? I say, well, are you taking full advantage of your 401k through work? Well, no. I was like, okay, well, let's look at what that would look like. Are you able to live off $500 less a month than you currently are? And so just looking at little tips like that will kind of help you make a decision as to whether there are little levers you can pull to reduce your taxes. But I fully agree with you. I think if I knew nothing about tax and I was sitting listening to here, I would say, well, that's great. Microsoft gets to pay 14% less on all of their earnings, and the individual benefits that I get last for 7 years, and that's and so there's a lot of push and pull here. You're not alone in feeling that there's some inequity to this. I think there certainly is. It just happens to be on what side of the aisle do you stand on, whether you feel good about it or not. So.
I think the one other thing I might say is the child tax credit, dependent credits too. Just making sure you're taking advantage of those. I think a lot of times those are overlooked by people, and it's free money and something that definitely, to your fact pattern earlier, would benefit someone.
And part of it's refundable now too. So
yeah, absolutely.
So even if the credit wipes out all of the tax you owe on your wages, you get to get money back from the government, which is a nice lower middle class perk there. So.
Yep.
All right, well, I think that's going to wrap up the session. I'd like to thank everyone for joining us, and we'll be moving into the general session shortly here. And for those of you who received a survey at the beginning, if you take a minute to fill that out, we'd appreciate it. Thank you.
Thank you.
Thank you.